Hello there, everybody. Michael Silva, you are watching the Stock Market Brief Show. What is going to happen to the stock market in the upcoming recession? I'll tell you what, it does seem like we're going to be heading into one very, very soon. We're going to get into those charts. I'm also going to share you some ideas for how to trade this environment. I'm going to share a couple of trades that I took today. And then we're going to get into some lower time charts and just get an idea of today's big old bouncy boo. So let's go ahead and get into today's episode. All right, everybody, welcome back to the show. If you haven't done so already, come on, give me a thumbs up. It's greatly appreciated. Helps bring this channel out to more people and so forth. Put a lot of work into these type of videos. So today we got United States ISM manufacturing number, okay? And it came in at 50.9. When it's below 50, it gets into contraction. It's into a contractionary period, right? Above 50, expansion. Below 50 is contraction. And the reason why I'm highlighting a couple of things here is because I'm highlighting 2001 and 2007. There's been other times, right, that we've got into a contractionary period. But the reason why I'm highlighting these two specifically, because we're not too far off to getting into contraction, I'll walk you through. First and foremost, if we take a look at a big picture monthly chart of the S&P 500, below us we're looking at the yield curve. What the just monkeys did that happen? Okay, there we go. We are looking at the yield curve below us, okay? So that means 2001, that's when the yield curve inverted. The yield curve inverted and going into 2006, 2007, and so forth, and we're deeply inverted again. We actually haven't been this deeply inverted for quite some time. It even went further into inversion today on this data, this economic report. Okay, so the reason why I'm showing the tens and twos right here is because this has been the best indicator for forecasting a recession up ahead. Okay, so being that we're so deeply inverted, we're going to go into a recession, right? It's going to be very hard to overcome this without going into a recessionary period or into a contraction phase. Is it possible? Sure. Anything's possible, right? But as it stands right now, we're looking at, a very deeply inverted curve, which is not good by any means. Now, if we take a look more specifically at this number, it came in just above 50, so we're technically within that expansion phase. But if you break down the metrics even deeper, you will notice that there are areas of contraction within the report. Now, another thing that I want to call out is just this 10-year period. This 10-year period gives some insight, and the reason why is if we zoom in, you can just see the structure of the ISM manufacturing number. It looks very similar to something, and that very similar something is the copper to gold ratio. Why is it important to know that this is tracking? Well, because we're looking at a couple of things, right? Dr. Copper, which when copper is doing very well, especially relative to gold, the economy is typically doing well. This is an economic metal over here. And then you have gold, which is more of a safe haven, quote unquote, type of metal. So as you see, if I flip back and forth, right? 10-year of the ISM number, 10-year of copper to gold, right? Now let's stack them on top of each other, and you can see that they track very, very well. Now, what does this tell me now? Well, as we're breaking down, potentially going down through 50 here in the near future, this leaves room to go down, right? So what does that mean? It means copper, Dr. Copper, the economic metal, is going to potentially underperform gold or head lower. And if that's the case, and gold, the safe haven metal, starts outperforming, which means this line right here would be going down, well, that tells us something about economic conditions. It tells us that we're most likely headed to a recession. And these are all early notifications, early indicators. Now, I know today's trading day, everyone's all getting hyped up on a day that we went up. Well, guess what? In bear markets, we get rip your face off rallies. That's nothing new. We were overextended in pretty much just about, everything, right? Like I will go into those indicators momentarily, but we were very overextended. BP charts, right? We had some bullish divergences forming, all kinds of stuff. Now we're looking at midterm seasonality. Basically, if you just look at this chart alone, bam, we go basically straight up into October. Okay, cool. But now if you break it down a little bit further, where we tracked it yesterday to 2008, it matches and it's a little bit differently. If we dive in a little bit deeper to seasonality, you can look at second-year Democratic president, and we look at the red line, and you can see that we still actually get some sort of a rally in October, which is very similar to 2008, and then we get a flush below the prior low. So we got to be open for the potential of more of a rally, right? And then also, we got to be on guard. That's all that this is telling us right now, okay? Now, yes, we had a sea of green, and inside of all this green, I see one little tiny slot over here. That was Tesla down almost 9% on the day, right? I remember tweeting something out like, this looks like, you know, a CTA's next victim, and it's down about 15, 20% or something from that tweet, maybe a little bit less than that. Maybe it's like 16, 15, 14%. I don't know. But it's got hit. And now, luckily, the market managed to survive. And by the market, I mean the mega cap stocks, right? Apple was up 3%, Microsoft, right? We're talking, these are all hitting 52-week lows. So, of course, we're going to bounce. And we have to be prepared to take advantage of those bounces, which I'll show you today how I went about doing that so you can do it yourself while you're trading. Now, whether you're swing trading or day trading, I'm going to show you what I did during the day, because during high times of volatility, I typically trade more. And when volatility starts subsiding, I like to put on more substantial swing trades. Unfortunately, in a swing trading environment, when volatility is high, a lot of false breakouts occur and a lot of whipsaws. So if we take a look over here at the 11 sectors that make up the S&P 500, everything was in the green. I want you to pay attention to energy. Energy was up 5.65%. Holy macaronis. That is very, very high. So we'll continue to watch that. Now, when energy opened up on the day, it was up like already 4%. That right there was a big trigger for me. Financials started getting hit out of the gate, but we remained starting to catch a bid. Energy and financials are a huge weight on the S&P 500. So today I decided to trade the S&P 500. So we're looking at a 2-minute chart of the S&P 500. I'm going to walk you through my exact trade setup. So we gapped up. Right now, I wasn't holding in my trading account overnight this specific thing. So we rallied up. Right, I'm not gonna just join into this little tiny like obnoxious volatility outside of the gates. I want to see where price is going to potentially go. Now on the 2-minute time frame, we started selling off right out of the gate. Why? Well, financials started peeling back, okay? So I just waited. I anchored in a VWAP, right? So this is the daily VWAP, and then we started to see this hammer candle, which started to explode higher. I still did not enter in, right? But now I'm already looking, okay, if we're going to hold the VWAP, I'm not going to chase this, but if we're going to hold this by pulling back, it'll allow me to potentially have a stop just under right here. Okay, so as we were pulling back down into here, it started getting below it. I said, it doesn't look like I'm going to be entering it, but then we created a hammer candle and we got above it, kind of a little flag pattern right there, right? And then I entered in right here. Now, I tried to get this out into the Patreon group before this bar, but this bar, yes, it's on a 2-minute chart, but that happened within like a millisecond, right? It was a massive move very quickly, led by the financials catching a bid. Okay, so entered in right here, and then I had the stop loss right here and right here. Okay, and I just let it go basically, and then when we pulled back up to here, I added a new stop, right? And then it started continuing go in my favor. Cool, pulled back, added a new stop, went up. Then it started pulling back, right? And boom, added a new stop, and then started going up. I added another tighter stop right there, and I got stopped out right over into this range, okay? Now, you might be looking at that, right? But this is in hindsight. But the market shot up even further. And this is the thing, right? I stopped trading. I went to the gym. It went through a consolidation period, and it stayed above the daily VWAP. So that is positive. So if you were watching this closely, you could have very well saw that, hey, it's still flagging right here. It's above the daily VWAP. I'm going to take it when it gets back above this level over here, right? And then as you can see, we had a very tight consolidation and we started breaking from those levels and squeezing higher. And yeah, we sold off a little bit into the close. So it all stemmed from this right here. And the reason why I like these type of trades so much, I didn't know it was going to turn into a trend day, but it allows me to have very, very solid risk to reward, right? I started off having 2 stop loss. I had a 50% stop loss here and a 50% stop loss here, and we started moving up, and that started to change as time progressed. Now, I'm not going to try to take profits, right? I'm not taking profits right here because the trade is working in my favor, right? it's working in my favor. Why am I going to take away from something that's working? And on the other flip side of that, why would you add to a position that's losing? Okay, so that's my thought process. That's what I did. I hope that kind of gives you some insight to potentially take advantage of the next trend day. Why would I go long when the market's been crashing? Well, because we've been oversold. Okay, it's as simple as that. We've been in oversold conditions. We're likely to get a bounce, and I want to be able to catch it. That's what I did. I hope that helps out. Another trade that I looked at earlier today was Tesla, but this I actually didn't enter, and I'll show you why I did not enter. First and foremost, I was looking at it more here throughout the day, a little bit later into the day, and this right here was just kind of consolidating. And this, I didn't have my entire setup with me for one, but I put on a buy stop order through my app, right? Buy stop order above this line. And as price was basically consolidating over here, I knew that, okay, so as it's consolidating, you know, if we start bumping it back up into this area, I'll just have a stop beneath us. And if the stop is triggered, you know, before the breakout, I'm just going to walk away from the trade. So that's exactly what I did. The stop, it was taken out, right? It wasn't actually a real stop there. I had a buy stop order up here to take me if we started moving back up into the daily VWAP. Now, one thing to note, this daily VWAP, where were we trading when I was looking at that trade setup? We were trading below it. So you need to be very aggressive on those type of trades if you're trying to go long underneath a daily VWAP. I don't recommend it, but if you're tactical, you know, it can work out. And if you're willing to just walk away from a trade and miss, right? I missed that, right? But I mean, it came right back down. I missed it, but I don't care because there's going to be better setups. Now, another way that you can look at this type of trade was the exact opposite of what I did here. Okay, right here at the very beginning, take a look what Tesla did. Tesla gapped down. So we already had bearish momentum as it closed, you know, massively down on the day. It closed 8.62%. Okay, so as it closed down, you do not want to chase this party straight down, right? You can get into a lot of trouble. And so the people that actually shorted right up in here, which there's probably people that did that, we got some rip your face off type of move early in the day. And then you have people like scared and potentially trying to cover right up into that area. Well, we came above the daily VWAP, we came back down, and that right there, that type of move is exactly what you look for a good risk to reward setup. So you could have had a stop right here, and you enter right here on that breakdown, and you can see as price continued throughout the day, right, it broke down, we came up, boom, and as we started selling off again, it still didn't hit the stop that was right here or right here. So then you could update your stop. It started going down, started coming back up, boom, boom, right? Then you could have added, you can just change your stop up to this ray, and then it would have just went around, boom, right? Then you maybe would have kept your stop, right? It's pretty similar in this area. And the reason why I'm telling you this is because I saw this setup later on into the day, right? And then I started looking at it from, okay, well, where would shorts cover and where could we potentially squeeze to if we start breaking their potential stop right here? And my guess was to the daily VWAP, and that would be a good little scalp trade. So that's why I decided to do that. And I was wrong, obviously, but I never entered into the trade. It was a shakeout and then the boom to the upside, right? So it ended up playing out. I hope that gives you some insight. We're gonna hop into the S&P 500 right now. It's not too far off the weekly expected move. You can see here that we're running in. I'm gonna show you some VWAPs here, and then we're gonna get into the 5-day moving average. Okay, VWAP, FOMC VWAP is the white, CPI. The last CPI print right about 375.47. The numbers are right here on the screen. Those are levels of interest that we're going to be paying attention to. And then obviously the orange line at 369.24 is the upper weekly expected move. I will go over the volatility channel or chop box, I call it, you know, that we're kind of in. But as it stands right now, here is an anchored VWAP to the low, this kind of capitulation move to the downside, and then we had a gap and rally. So I would be paying attention to, if we get a pullback, if you want to go long, pay attention to that daily VWAP. And right now, right, it's going to change throughout the day, tomorrow's trading session, but 360, 333. So that can be an area that you can potentially watch for to see what happens going into tomorrow. All right, if we take a look at the 15-minute time frame, this is the same story we talked about the other day, right? So do not get overly excited about these little rallies. Can we get continuation to the upside? Yeah, sure, right? We're back above the 5-day moving average. It's starting to flatten out. That's what we've been waiting for. But be patient, right? Be patient for the right setup. You do not want to chase. What has chasing caused? Chasing has caused agony. If you chased up into here, if you chased up into here, if you chased up into there, if you chased up into here, all right? It's constantly just been, open interest and, gamma risk most likely is just building with up into this channel. And we're going to see some sort of explosion, whether that's to the upside or downside here in the very near future. What I like seeing right now from a bullish perspective is that we're starting to obviously potentially build out a bottom. The 5-day moving average, as we're trading above it, that's good, because as the days continue, right, we have 1, 2, 3, 4, 5, right? So this day is going to go away, right? So this is going to continue to flatten out more, right? And as long as price can continue to stay above it, then it might offer up some good opportunities from a risk to reward standpoint. Let's take a look at the Qs. Qs did not tag its FOMC VWAP or the CPI VWAP yet. We're not too far off the upper weekly expected move, and you can see as well from the 15-minute chart, we are right there at the 5-day moving average. The last time we were there, the last time we were there, the last time we were there. It is starting to try to flatten itself out, right? We have 1, 2, 3, 4, 5 trading days, right? So we're going to start losing this data right over here. So that means that we're going to have a 5-day moving average based off of this data right here going into tomorrow. So this should flatten out like this if price wants to, dribble around right here, maybe build out a little inverse head and shoulders if we are trying to build a bottom. So that is something that we could potentially pay attention to. IWM has been putting in some higher lows, which is nice. We have a low, a higher low, a higher low, a higher low, and a higher low right here. So this one is doing better than most. However, overall, right, we're back above the FOMC VWAP. We're above the daily, the low VWAP right here, but we're still below that CPI VWAP too, and obviously the weekly expected move. We're not nearly as close to this weekly expected move as we are on the others. But if you do zoom out, take a look at the 5-day moving average. It is starting to turn up. Price action starting to move up here too as well. So maybe we take some more time to build a potential bottom. But here's the problem here. Here's the problem. If you just look at this channel that it's in, right, the chop box, all it's doing right now is just chopping people to shreds before it actually picks a direction. So we need to watch this channel breakout here and be very mindful of the risk in entry, because, right, contraction leads to expansion, or expansion leads to contraction. If this is expansion, right, if this move down here was expansion and this is contraction, this contraction right here is pretty gnarly, in my opinion, okay? If we keep continuing on, we have that positive divergence playing out right now. This was the smart money versus dumb money. Smart money's up top, dumb money's down here, right? The bonds, HYG over SPY. We're looking on the hourly time frame, higher low, lower high. SPY is playing to the upside. We talked about that one on a prior video. We talked about this one too as well. This gives us a leading indicator of potential changes in volatility. When it gets above this 1.3 over here, it's highlighted in red and pink, we can typically see spikes in volatility. But when it gets below minus 2%, right, we went over that, there's been times where volatility subsides. And guess what? We hit it, multiple times right here. And, volatility is starting to subside a bit. It doesn't tell us how much it can subside, but it gave us the heads up notice that we could see it subside. And guess what? We got under 20 or under 30. However, it is still elevated. It's at 29.63 for the VIX. For the VXN, it's at 35.56. Okay, careful. And then Russell volatility is at 35.81 still. So volatility is still very high, everybody. As we talked about previously in other episodes, many BP charts have been oversold here, and we're starting to get some relief moves, but you can see it's still in that oversold condition. We talked about the advanced decline volume line being that oversold condition. Guess what? Every time it has done that, we've seen some bounces to the upside. So can a bounce continue? Obviously, we need to be prepared for it. You can see right here, after today, it could be the early stages of a possible bounce. We don't know how high that'll go. Even advanced decline cumulative line over here too as well. It was getting overextended, small little divergence built out. So you can see, yeah, maybe we pop up a little bit. That's a total possibility. We were also overextended on the percent of stocks above the 50-day moving average and percent of stocks above the 16-day moving average to the downside. You can see when it gets below that minus 10, we've seen some bounces in the S&P 500, as you can see on this chart. Same with the 200-day moving average, and we're still pretty beaten up. So overall, when we really take a look at this market, it is in oversold conditions. We're starting to see a bounce. It looks like we're heading into an economic recession. We have a yield curve that's deeply inverted. Do not call for a bottom. Just be prepared if the market wants to bounce higher. But you need to understand, on the flip side of all of this, what happened to the market the last time that the ISM went under 50 going into a recession. Well, the last two times was 2007 and 2001 when we crossed down through this 50 point on ISM. Very similar, right, to what we see here on the US 10-year, what happened to stocks. That's what we're talking about. We saw a 51% decline. We saw a 58% decline. Right now, we're sitting at about, a 20-something% decline on the S&P 500. Okay, somewhere around there. And we have that yield curve that's inverted. So is it crazy to think that we can see a move like this? And if we do see a move like that, where would it take us? It would take us to S&P 2500, and that is minus 50% from its peak to down there. That would be similar to what we saw in the dot-com bust and the great financial crisis. Hope today's video helped out everybody. See ya tomorrow.